Respected Mr. Mahalingam, full-time member of SEBI, Mr. Balasubramanian, CEO of Aditya Birla Mutual Fund, Madam Swati Kulkarni, Executive Vice President UTI Mutual Fund, Mr. Arun Ladha, Managing Director of Birla Financial Services, and our esteemed audience. A very good morning to all of you. It's my pleasure to welcome you to this e-conference on fundamental and pandemic agnostic investment. Today we have a panel which is kind of unparalleled. We have a regulator, the senior most officer of the regulator we have with us. We have the CEO of one of the largest mutual funds. We have the fund manager who has substantial experience. They're actually managing funds, and we have the investment advisor, Mr. Arun Ladha, who is actually at the forefront advising investors on their investments, and actually he faces the investors. And today, we have to take on this topic. Post re-election of the BJP government, the market got a reassurance of the continuation of the economic policies. The GDP growth was estimated at 5% for 2019-20 and was expected to continue for the further years. Based on expectation of this further growth, the markets also continued to move upwards. And the broader market index, Sensex, moved from about 37,000 in May 2019 to about 41,900 in January 2020. However, the emergence of coronavirus in January 2020 put brakes on the growth. The spread of the deadly virus all over the world suddenly stopped all activities of investment. Not just investment, it's rather stopped all activities of mankind. All activities in economic activities came to a standstill. As the government lockdown, the stoppage of all activities impacted the stock prices all over the world. The Sensex, which was 41,952 in January 2020, swiftly crashed to 25,981 on 23rd of March 2020, which is a very substantial crash. And this impacted the portfolios of all the investors. The investors all over the world, including India, have been very concerned, and they look at losses. They look at losses on the job front, they look at losses of economic activity, and they also look at their portfolios having shrunk very substantially. In this situation, people are really wondering whether we should continue investing. Should we only concentrate on saving lives, or even continue with the economic activities? Why should we continue with investment? And if we continue with investment, what is a safe way to do it? With so much erosion, whether people should continue? This is a question topmost on everyone's mind. And to answer this question, we have with us this panel. I will briefly introduce the panel members to you. We have with us Mr. Mahalingam, who is the whole-time member of SEBI.
Hello.
He looks after the corporate finance department, the foreign portfolio investors, investigations and services, and education.
I'm just trying to concentrate on what he's talking. Very deeply I'm able to get.
Yeah. Prior to the current assignment, Mr. Mahalingam was the Executive Director in Reserve Bank of India and looking after market operations, both rupee liquidity and foreign exchange operations. In his stint of 34 years with RBI, he has taken on varied roles like Chief Forex Dealer, Chief Investment Dealer, Head of Debt Management. He has also been actively involved in regulation and development of money, bond and foreign exchange derivative markets in India. His prior assignments in RBI include bank examiner, as also a member of teaching faculty at RBI Officers Training College. He is a master's degree holder from IIT Kanpur and an MBA in International Banking and Finance from Birmingham Business School, UK. We also have with us Mr. A. Balasubramanian, who is the CEO of Aditya Birla Mutual Fund. He brings with him over 26 years of experience in the mutual fund industry as a portfolio manager, both in fixed income and equity. Prior to assuming the role of CEO in 2009, as Chief Investment Officer from 2006 to 2009. As MD and CEO of Aditya Birla Mutual Fund, he currently oversees more than 28 billion US dollars worth of investments. As Aditya Birla Sun Life, he is closely associated with key industry bodies. Currently, he is on the board of governors of NISM, National Institute of Securities Market. He is also on the committee of corporate bond management of SEBI. Apart from these prestigious roles, he plays an active role in AMFI as a director. He was the chairman of AMFI from 2016 to 2018. He has done his BSc in mathematics and MBA, apart from being an alumnus of IIM Bangalore and Harvard through our advanced management program. We also have with us Madam Swati Kulkarni.
Hi.
Who is a graduate in commerce and an MBA from Narsi Monji Management Institute. She also holds a CFA charter conferred by the CFA Institute and a certified associate of Indian Institute of Bankers. She has a professional experience of over 29 years, with most of it with UTI. UTI, as you would be knowing, is the first mutual fund in India, which was set up in 1964. And she has over 28 years of experience as a fund manager with UTI. She manages 3 equity funds with assets of over rupees 10,000 crores. We also have with us Mr. Arun Ladha, who is the managing director of J.R. Ladda Financial Services Private Limited. This entity specializes in money management, portfolio management, and corporate finance. His experience goes back to 1995 when he set up this business. His company advises on assets worth more than 8,000 crores and has offices in Kolkata, Mumbai, Delhi, and Singapore. He's an eminent advisor and receives lot of awards. His vision he got the Best Financial Advisor Award by CNBC TV 18. He is also involved in raising short-term funds in the form of ICDs to corporates from family offices of large groups. Further, he advises individuals and HNIs on their portfolios on a continual basis and very successfully. So, ladies and gentlemen, this is the profile of our panel, and as you would see, we have a really very well diverse panel. I would now request the panel members to say a few words. I would first request Mr. Mahalingam, full-time member SEBI, to say a few words on the current conference.
Thank
Over to
you.
you, sir.
Am I audible?
Sir, yes, sir.
Okay, thanks a lot. Thank you for that nice introduction.
Hmm.
And first of all, I would like to profusely apologize for not being able to come on the audio mode. There have been some kind of problems, so I'm coming on the video mode. But I'm quite interested as far as this seminar topic is concerned. It's a very timely topic. All of us know that we are going through pretty difficult times right across the world. This kind of a situation has been unprecedented for the whole world. Whatever may be the predictions that they are coming as far as either the ailment is concerned, about the cure for the ailment is concerned, or the ramifications on the economies, global economy, the impact on the Indian economy, the growth prospects of the global economy and growth prospects of the Indian economy. I don't take it with a pinch of salt, I take it with a bag of salt. For the simple reason that nobody has been in this situation before. So all the predictions are at best guesstimates, whether it is a vaccine for this ailment or whether it is the economic growth going to be U-shaped or V-shaped or W-shaped or whatever alphabet that you can call. I'm not too sure about it at all. Clearly, when we come to Indian economy, I think Indian economy was passing through a fairly difficult stage even before the COVID times. I think our GDP was inching closer to 4% from a real heightened level of almost about 8 to 9%. Almost about 3 years back, it had plunged about 4%. Inflation was in the lower ranges, no doubt, but the fiscal deficit had reached 3.4%, and the government itself was expecting it to close in somewhere about 3.5 to 3.6. That was the story before COVID. The external sector was reasonably okay, it was in reasonable health. So that's the background as far as the macroeconomy is concerned when COVID struck, and it struck all of a sudden without anybody anticipating. So clearly the world economy was not prepared for this kind of an onslaught for which the world had not found a solution, the world had not found a way to fight it back. Given that it's a kind of a pandemic, I think most of the global economies, including India, went into a lockdown mode. We are today closer to the 100th day of lockdown. To be very precise, we are on the 95th day of lockdown. And if you look at 95 days of lockdown, which means almost about 1/4 of a year is gone in this. So of a $3 trillion economy, I'm not playing any economic modeling, I'm just saying, out of a $3 trillion economy, if 1/4 of this year is chopped off, and if you say a linear proportionality here, which means 1/4 of the GDP is going to be lost, which means almost about 800 billion GDP is lost of $3 trillion economy. So, if this is going to be the base case scenario, I'm calling this as a base case scenario because we still don't know how the scenario is going to unfold itself in times to come. We don't know how long the entire production facilities across the country, across the globe will get stuck up. Although we are aware that some of the production facilities, some of the companies have started opening up. We don't know to what extent they have opened up. We don't know to what capacity are they functioning. Clearly, at least in bigger cities like Bombay, the normalcy is still far from achieved with that public transportation still in the halt mode. I think people are still not able to reach their work spots at all. Why I am giving this background is that the GDP is still trending down, is likely to trend down. I am not willing to make a guesstimate of where this GDP is going to be, while the world, at least some of the important organizations across the world, they are talking about -4.1 for India. Again, I don't know to with what extent we can take this figure at face value. But what is clearly going to come out of this is that the interest rates in India are not going to look up at all, at least in the immediate future. That means for the common investor, if we look at the repo rate of Reserve Bank of India, it's going to be trending down, which means the bank deposit rates are trending down. So on a typical fixed deposit where a common investor was earning about 7 to 8%, he can no longer look forward to that kind of a return. The return that he should be getting attuned to is in the ranges of almost about close in the ranges of 4 to 5%. Now, this is what makes the entire investment world and the capital markets a pretty interesting arena, which means particularly the retail investors and maybe many of the institutional investors, they are not going to be happy with either the normal bank deposit return or the GSEC return, and perhaps people are looking beyond these asset classes into the asset class of maybe the capital markets, which predominantly is made up of mutual funds, alternative investment funds. We have other forms like REITs, InvITs, we have gold. All these asset classes are now attracting a lot of attention. If this seminar is going to be more meant for the common man, I think my simple message to the common man here is, you have to be very sure, you have to be very careful before you get on to the other asset class. I mean, whatever may be the asset class, beyond the safer asset class. Now, if you are a new entrant to the mutual fund, or you are already into the mutual funds, I am very sure you must be looking at three basic characteristics of an investment portfolio. Number one, safety. Number two, liquidity. And number three, return. Now, in what order you are going to juggle this is going to be a function of your investment profile. If you are a youngish investor in the age group of about 20 to 30, maybe return is right at the top, liquidity at the second, and safety at the third level. If you are a person who is living out of pension, living out of savings, you are leading a retired life, the entire objectives are turned topsy-turvy. You are going to be looking at safety of the investments, liquidity of the investments, and come to return at the back end. So clearly, your investment objectives are going to be a function of your age profile, your risk appetite, the kind of money that you are willing to dabble, willing to put into risky portfolios. When you get into some of the asset classes which are beyond the bank deposits, as a common investor, I think you need to do a tremendous amount of due diligence. And that due diligence would encompass looking at and understanding the product that you are investing in. Now, I'm not getting into the details of it, but I thought that for a seminar like this, I think the investors would have to do a great deal of due diligence in these difficult times before getting into any asset class far removed from a bank deposit. Now, I am not saying again for a moment, please don't think I am saying that the bank deposits are the safest or the bank deposits are safe at any time. We know what happens to banks in difficult times. We know what happened to a bank in India in the recent past. We cannot be lulled into a sense of complacency that the bank deposits are the safest. But if you are moving away from the bank deposits in search of a slightly better yield, I think a greater amount of due diligence is called for in understanding the features of the product, in understanding the covenants attached to the product, in understanding the payoffs associated with the product, in understanding the past performance of the product, in understanding who is managing the product. All these are something which warrants a very close study on the part of the investor. I am not sure whether many common investors would like to do this kind of a study. Now there are people who say that that's why I am putting this money in the mutual fund, and the mutual fund would do this study for me. Yes, I agree with you. I don't differ with you at all. But then I would like to know, when you get into a mutual fund, do you do this kind of a due diligence study, even as far as the mutual fund is concerned? Do you do this due diligence study as far as the scheme is concerned? Do you do this study as far as the disclosures of the mutual funds are concerned? Are you a person who is keenly looking forward to the disclosures? Do you get into the website of the mutual fund to see how your scheme is doing? What are the products in which it is invested? I would clearly request the investors to look into this. Now, this is a very brief thing. I will come to the detail of it much later when we go into the conversation more. On the other side, the mutual funds are sitting here. I am only addressing the mutual funds here. I am not addressing the other asset classes, because this seminar is meant for the mutual funds. The mutual funds and AMCs owe a lot to the retail investors in these difficult times. While SEBI is doing a lot to bring about a clear-cut understanding as far as each and every scheme is concerned, whether it is true to label and all that, I would definitely look upon the AMCs, I would definitely look upon the trustees as the repository of faith of the common investor. Now, why do you call this as a repository of faith? Look at what happened from the time the global financial crisis started and the interest rates went down, and a large volume of retail investors started thronging towards mutual funds, with the result that the asset under management of the mutual fund industry, it took a jump multi-fold from almost about 5 lakh crores to about 28 lakh crores in a matter of just about 7 to 8 years. That is really built up on the pillar of faith that the retail investor is reposing on the mutual funds. Now we are again going through difficult times. Now this is the time when the pillar of faith has to be strengthened by the AMCs, the pillar of faith has to be strengthened by the trustees, and the pillar of faith cannot be allowed to be weakened even by a notch. We know we have gone through very recent mishaps in the mutual fund industry also, that have shaken up the mutual fund industry. Investors are asking the question, is mutual fund good for the retail investor? Clearly, the AMCs, clearly the trustees should stand up in unison and say that, look, we are for the retail investors, and you should be doing all that is within your might to ensure that the faith that has been reposed by the retail investors does not get eroded, that you have to again do a Herculean task to get the retail investors back in their fold. There are a lot of things that you need to do, and I will again come back to it a little later. But all that I want to say is that there is an equal amount of responsibility, there is an equal amount of, I think, a kind of faith repository, that role that you are taken up. It requires a tremendous amount of give and take on your part to ensure that the retail investors stay put, stick to this industry, and they do not go away out of sheer frustration that this industry is something prone to all these zigzags. And clearly a lot depends upon the mutual fund trustees, the mutual fund CEO, the mutual fund manager, and every single officer and employee of the mutual fund industry. So a lot more needs to be done to ensure that I think the mutual fund industry stays on very, very stable track. I would like to close my initial words only with the words that we are in difficult times. A good part of responsibility is there on the retail investor. More of a responsibility is there on the asset management companies and mutual funds themselves to ensure that they are all staying on track. Thank you.
Thank you, sir. Sir, may I request Mr. Balasubramanian, MD and CEO, Aditya Birla Mutual Fund, to say a few words.
Yeah. Good morning to everyone, and thanks to Mr. Mahalingam, who just gave his wisdom and vision for the mutual fund industry and broad the economy, how it's going to shape up post COVID. I think, as he said, clearly it's this crisis that we have seen in the last 2.5 months or 3 months is something is unique, unprecedented, never happened in the world, at least in our own memory of being in the industry for the last, say, 3 decades or 2 decades or 3 decades or 4 decades. The last that probably the world would have seen the swine flu which hit the world, and post that we have seen multiple crises. The another crisis, of course, we saw in the 2008 crisis. It is more related to the financial market and originated from America, of course, spread across the global market. And that's the time actually we could see how the regulators and policymakers can come together and work towards bringing back the economy back to normal. That's something something we saw as a unified action that was being brought in by the G7 countries and G20 eventually. And that's something we saw it. We were just doing some analysis, what the parallel between what we have seen today and what we saw in 2008 crisis. And when we are looking at that, the steps that are being taken by the various central bankers and the policymakers, the event that happened in the month of September 2009, and the action started coming in from the time of November. It took about 2 months for the action to begin, and then they kept on doing many things based on an experimental basis in order to revive the confidence, revive the economic growth for almost a period of 81 weeks. Whereas compared to that, what has come today as a response to the COVID, as a quick reaction that has come from the global central bankers, it's something is amazing. And the way I think the regulator, especially the central bankers, have reacted, the kind of money that they pumped in it's something which is unimaginable. Keeping in mind the COVID impact is quite severe in taking the economy back by about 1.5-2 years, and therefore one need to come back with respect to the growth path and without getting the global economy into recession. And that's something I think they thought through it, and they have reacted quite substantially in pumping the economy. Not of course boosting the economy in terms of the spending, but definitely they're ensuring that the liquidity is provided. The way it has been measured, it's almost about economies like US, economies like Germany have spent close to about 10 to 11% of their GDP in the form of providing liquidity and backstop facility to the corporates and provide liquidity to banking systems. Therefore, we don't have any issues surrounding the banking and financial sectors, which is the proxy to the most of the economy. That something is given as support that has come from the Fed government. It's something it's never one would have ever thought about it. Such a large sum of money will be pumped in. The second, of course, with also done with respect to the corporates. At the end of the day, the stock market is driven by the corporates, how they are going to perform the new COVID world. Definitely, on one side, the liquid is being provided in the form of the guarantee systems or the form of providing direct liquidity to the various corporations in managing the current situations with respect to the cash flows, with respect to the liquidity, and not with respect to, of course, the profitability. Of course, profitability is a function of sales, which will come over a period of time. But definitely the liquidity is one thing that's been addressed, and across the board, even India also have taken many steps. Then within India, there's one other measure which of course I keep taking is the way I think the Reserve Bank of India has reacted from 23rd of March, 27th March. Since then, the 23rd March is the lockdown started, but 27th March is the day where the Reserve Bank of India has cut the interest rate and started providing liquidity to the systems, foreseeing that Indian corporates will struggle over the next 2 months because of lockdown, lack of sales, and business not going to be that great. Therefore, during this period, one has to provide greater support. I think first time ever I am seeing in my own lifetime the kind of support that has come from the Reserve Bank of India in pumping in liquidity and bringing in the interest rates to as low as about 4% or even less than 4%. It's something it's all intended towards a quick reaction and ensure that the economy, while it suffers in the short term, at least in the medium term and the medium to long term, is something that comes back. So that's something which I see as a big thing that has come as part of the COVID. Second, of course, has come as part of the COVID, and the 2 months of lockdown has also given a greater learning for most of the corporations, including money managers like us, how one should remain efficient during this period of COVID, and the learning that has come, adapting to the change, adapting to the technology, adapting to the focus on reduction of cost in order to ensure that the future the business will be completely different from the way we have been running the business for the last, say, more than last some number of years. And that also undergoes a change, which is nothing but indirectly bringing in efficiency in the way the corporations are run, the efficiency in which the individuals are driven, the efficiency in which the market will functions, which again ultimately will lead to an improvement in ROE, will lead to improvement in the way the companies are managed from the shareholders' point of view. Therefore, one may see some kind of uncertainty, one may see some sense of darkness in everything that we are saying, but definitely the COVID is changing the way the business model is run, and the way I think central bankers are reacting, regulatory policy makers are reacting, both at the government level as well as the central bankers and all regulators coming together and supporting. I think it would eventually give a gradual pickup in the economy, a gradual pickup in the confidence boosters, and that's something which in my view will drive the overall economic growth as we move forward. Definitely, of course, one has to live with 2-3 months of uncertainty, because this is not something which I never seen. I think probably first time ever in the life, companies selling two-wheelers or cars would probably say that I had a zero sales in the month of April, we had a zero sales probably in the month of May. I don't think it would have ever happened in their lifetime. A company having a huge base of operation and then coming out openly and saying that they had a zero sales. That's on the one side. But the other side, companies who are in the consumer staples, so they had a huge amount of sales. Because another day, of course, food consumptions probably has gone up. Maybe the way I think the whole logistic has functioned, the way I think the companies have actually managed to sell products that are more essential from the consumer point of view. Again, they have seen a different kind of learning and during this period. And even the topic of the discussion is a pandemic agnostic investment. That's something which I think again is happened. Of course, we'll discuss more in detail in the Q&A sessions. But having said that, from a mutual fund point of view, I think one of the points Mr. Mahalingam has mentioned that the SLR, I call it an SLR, which is nothing but a safety, security, return. And it has to be a permanent concept for mutual fund in order to provide a greater experience to the investors. But of course, times like today and also the times like what we have seen in the last 2.5 years, a financial market crisis we saw in India, and followed by COVID, did not give a greater experience, and the kind of volatility that we saw in the month of March and the equity market fell by almost 30%. And no doubt it took the confidence. But this similar kind of situation, we have seen this in the last 3 decades, multiple number of times. There are some events will come and take the confidence of investors, will take the confidence of money managers. At the end of the day, what has actually remained steady and remain constant is nothing but the discipline of investing after understanding what is being done with respect to the portfolio, the purpose for which one makes the investment, and stick to the purpose, keeping in mind what is the goal for which they have put the money. And as long as you keep the purpose in mind, as long as the discipline is maintained, over a period of time, experience will turn out to be better than what one assumes. And during this period, it's something which is extremely difficult to take a phone call. I mean, what would work in good stead is keep a close eyes on SLR, which is the first over ability, then I think focus on return. As long as one doesn't chase return as a concept and then stick to the basic investment principles, probably the experience in mutual funds could be quite good over a period of time. In general, even in the capital market, the experience can be derived much more efficiently over a period of time. I'll stop here, and maybe you'll have more questions and interactions during your Q&A sessions.
Yeah. Thank you, Bala. Thank you for sharing your thoughts. May I now request Madam Swati Kulkarni to share her thoughts?
Sure. I'm going to share my screen and I'm going to show presentation.
Sure.
Can you see the presentation now?
Yes, it's visible.
Yeah. Basically, what I have decided to do is just one second. Yeah. So the quick presentation on the topic, I have outlined my thought process in this way. That is, quickly see the macro impact, what has been the policy response, as both Mr. Mahalingam has alluded to this. Central banks coming together and intervening and providing the much needed liquidity. What have been the market trends and how do we navigate these times, difficult times, with fundamentals, and a bit on the investment style. There are no prizes for the guess that FY21 GDP growth is going to be negative. However, we also expect that because there is demand and supply-led shock to the economy, government revenues are going to get affected. Unlike in 2009, when the economy was doing very well and government was able to provide revenue expenditure support, that is cash and taxes reduction, resulted in boosting the demand. This time, government revenues would be severely affected, and therefore fiscal deficit is also likely to increase. However, the inflation, thankfully, agriculture is likely to do well, and food prices are likely to remain under control. Inflation is likely to remain under control. This chart gives you a comparison versus the Indian fiscal packages. You can see here that the countries like Australia, Germany, Japan, and US have resorted to much higher cash transfers. This is a dark purple chart here, which can be seen here that it is almost about more than 7% is the fiscal support that these governments have given. Large part of support has also come in form of loans and guarantees, and therefore, on a total basis, even for India, the support looks at 10% of GDP, but actual cash going in the hands of the people is about 1.5% or so. The fiscal expansion is that. As I said, the intervention is pretty clear in this chart. Fed balance sheet expanded by 3 trillion in just a matter of a few days. They used the playbook that was there for GFC, they took a lot of time before the liquidity infusion decision was taken. Lehman had to collapse during that period. So there was a learning, and this time both the Republican and Democratic Party has come together, and in a record time they decided to lend this support. So their balance sheet now is in excess of 7 trillion. European Central Bank also spent about 1 trillion for extending the support. So was the Bank of Japan, which came up with about 500 billion support. So the support was very much there, and the risk aversion, which initially set in the markets, reflected in dollar index, of that moving from below 94 to about 103. That reflects the risk aversion because everybody preferred to move to dollar-based assets. That has since normalized with the liquidity being strong in the systems and the government intervention, and more to do with the support that or the confidence that investors have. You can see the movement in risky assets here. Brent fell almost about 60% in the first quarter of the year, calendar year, and that recovered quickly to about 49% as we see the intervention coming, liquidity improving, and so was the case with the most of the risky assets. And naturally, the gold actually didn't have that much gyration because gold is again thought of a safe haven by most of the investors. Looking in the domestic markets, you can see here that there wasn't much difference between how the large caps or mid caps or small cap reacted. You can see this from the fall in the various indices here listed here. And consequently, you don't get any idea about which capitalization would do well or has done well because the recovery was also very much similar. And even if you see 5-year returns, the differential is not much, though we tend to have a lot of debate around which is the best product that one should invest now given the market condition. I think this table clearly says that you don't get much clues about which particular segment should be preferred, except for small cap, perhaps that has, even on 5-year basis, has deployed value to the extent of 3%. If you look at Nifty 500 and bifurcate that between large cap and mid and small cap, that is, the top 100 stocks are classified as large cap, and SEBI categorization also refers this as the large cap space. The fall in the large cap was more moderate than what we saw in the 400 stocks. And here clearly this chart shows you that the fall was much higher for the mid and small cap stocks. So definitely mood swings that we have seen in the market actually reflect that there is no point in predicting where the markets could be when they'll recover, because you would have never imagine yourself in a month of March. It was like everything was looking so gloomy that people would have actually acted hastily also, some of them. But from April and May, and almost most of part of it was recovered, and now we are perhaps down only about 10% from Jan levels. So I want to just emphasize here that predicting market is actually a futile exercise. We should look at something more to deal with the risk from time to time. Now let us look at this table, which gives a slightly longer term performance of various segments, top 100 versus again next 400. You would see that here the negative returns across 1, 3 and 5-year period, when we are seeing in this current period of pandemic and looking back 1 year, 3 and 5 year, it reflects that the percentage of stocks giving negative return is far higher. That to an extent indicates that the risk could be also disturbs me is, or one should be cognizant of the. So in last 1 year, the 57% of the stocks in 100, that means 57 stocks have given negative return, 42 stocks have given negative return on 3-year basis, and 28 stocks have given negative return on a 5-year basis also. So are there any value destructors sitting, and those could be sitting across the market cap. That is the point which I want to make. Looking at the sector performances, and many of you would know, but I just thought it could be a good preamble to start with, that the perceived risk in certain sectors has clearly turned out to be much higher. You can see here the yellow bars are the fall period, and the recovery is the purple, and the gray bars tells you where the prices currently are versus what are in January. So Bankex, that is bank, down 20% or more compared to what they were in Jan. Whereas into subsequent part of my presentation, these are like FMCG, healthcare, IT. These seems to have contained the fall, and in fact, healthcare has done better. Only sector which reflects positive returns since over the Jan period also. Slightly longer term also here, it only indicates that there are sector specific challenges and risks and opportunities too, which reflects in the long term price performance. And certain sectors, again, I would emphasize here that which sectors which have a good amount of cash flow generation and high return on the capital that they invest tend to do well in a long period of time. So how do you navigate during this period? While it is one easiest way is to move to safest asset class, but that may not give you the required capital appreciation or the wealth creation that we have seen. Even if you look at the levels of Sensex, let's say in 2003 or 2005, and look at where the levels are today. So it's almost 6-7 times higher than those levels. And every time we had a crisis, we think that the risks are higher, but then those are the opportunities to look at these crises as an investment, because those who can have patience to stay put together for a long term, definitely that could actually help in terms of better capital appreciation as well. So asset allocation approach is what one of the fundamentals that one should navigate these risks through. But coming back to the pandemic, this only gives you a adequate experience that risk can come as a nasty surprise and from anywhere and any time. So we should, when we build a portfolio, we should be aware of that. And uncertainty is definitely there to linger. You could see that there are questions or doubts in mind when this infection will peak out, will there be a second wave as the economy opens up, and therefore consequent lockdown again? Could the customer behavior would change, whether they'll save more or will come and spend more because they themselves are not sure about their lifespan, or the borrower behavior, would there be a moral hazard? With the moratorium that we are seeing, will there be a tendency to not repay in time, because if in times of crisis there will be some big brother or a godfather would emerge and give us regulatory forbearance. Migrant labor is an issue. We have job and income losses. Fiscal support, whether it will come in the right quantity, in right time, those are the problems. MSME stress and so on. You can actually list and pile on the uncertainty that could play on. And therefore, one cannot really say when the markets would recover or economy would recover. But yeah, we will have to take a view, and we should think about what we can do to deal with this volatility. So clearly, there has to be a portfolio approach. You cannot, mitigate completely. We cannot have a foolproof solution to manage the risk, but we can only mitigate this risk very well. So, how do you do that? I think what the simple answer, but very difficult to practice, is moving back to fundamentals. We have to build an investment rationale based on the factual data and not mere the thoughts or expectations or the themes that are likely to play. Companies actually are valued as a going concern. You think of the company, let's say like Hindustan Unilever. Now I'm just giving this as an example. not soliciting any kind of positive view or otherwise, but these companies are there for 100 years. Don't you think there would have been so many ups and downs during these periods? If I look back in my own career from 1992 till date, there have been many various instances where the markets have corrected more than 20% and also has remained in the correction for a volatile phase for more than 1 year also. But looking back, those were with the opportunities to stay patiently invested. And now, of course, SEBI also coming up with a very clear groundwork as far as the framework, as far as where each fund is categorized, and bringing in that discipline actually gives you a fair amount of confidence that funds will not have one name and invest somewhere else. So that style purity will also actually give us confidence. And what I want to insist on this point is that when you look at the history of a company or the future of a company, these periods of difficulty actually have a small impact on the future cash flows that they would continue to generate, and those cash flows is nothing but what shareholders they invest in equity for those cash flows. So when you look at present values of those cash flows, the current pain or any pain which comes with the economic shock would have some impact, maybe about 10%, but not something which would actually make the investment argument weak. So the questions to ask or what we should know is that whether the company is generating cash flow consistently or not, and whether it is earning high return on capital employed on the capital that they invest, and that return should be operating cash flow may not be positive. The chances that these tend to improve, because when such things happens, the valuations could be very, very attractive. Now, are you able to see the file?
I think the sharing got dropped.
Hello?
The sharing got dropped, Swati.
Dropped, is it? Okay.
Yeah, even the voice also sometimes it breaks. I think the last slide that we saw was the 100 companies, the negative return. Yeah, now also is not coming.
Oh, it's coming?
No.
Just a minute.
Maybe you'll have to probably show during the Q&A time otherwise.
I think, Swati, it is taking a bit of time. Perhaps when we are doing the question answers, that time we can restart with the slide that you have missed out.
Stop for some reason. I will.
Yeah, I think you're connected.
Okay, so I spend close. Yeah, I'll just.
I think your voice connectivity voice connectivity is also low. The voice is breaking. I think what we'll do, we will request Mr. Arun Ladha to share his thoughts, and thereafter we'll see while we take the question answers at that time. Yeah.
Thank you, Mr. Gupta.
Yeah, thank you, Swati. Now, may I request Mr. Arun Ladha to share his thoughts?
Yeah. Am I audible, sir?
Yes, you are.
Thank you. Thank you, Mr. Gupta. It's my pleasure and happiness to join this August company where we are discussing this matter of fundamental and pandemic agnostic investment. We have heard Mr. Mahalingam, Oldham Right, Mr. Balasubramanian, market veteran in Birla Mutual Fund, and Ms. Swati Kulkarni, long-term fund manager in UTI Mutual Fund. As we all know, 2020, past 6 months, it has been a hell of a ride. Market has gone up, gone down in a precarious manner. The investor has lot more questions to answer than what we were 1 or 2 years back. Though investors have seen many past events like 2008 crisis or 2014 temper tantrum of Fed, but investors in this time have fared much more astutely and intelligent than the last few crises. But what I believe that each and every crisis there lies a different opportunity indeed. So far, for investors' perspective, also this crisis has given them a clear signal that how to approach to investments in a better manner. Investors have seen such precarious times that they would not have thought of 1 or 2 years back. Though market has gone up substantially because foreign investors have put in a large amount of money in past 3 months, and that has made the market move very sharply. But investors' emotions, which has been largely affected by this pandemic, is going to play a bigger role in the mind when they're thinking of investment right now. As Mr. Mahalingam has pointed out, that going ahead, interest rates will go down or will remain soft for quite some time. The expectations of investors need to be moderated. So, to handhold investors' hand during this crisis, we have taken many steps so that investors are aware that what can happen to the market during different times. We have held regular webinars and phone calls and brought many fund houses to the door of the investors through new technology so they can understand and take best possible decision in the current times. I think this crisis time has also taught us that how do we use technology or leverage technology to get better and more answers. Though Indian economy has seen a windfall due to falling crude prices, but what Mr. Mahalingam told us that 1/3 of the quarter's GDP has just been thrown out of by this pandemic. So catch up with this thing is not an easy answer for anybody. And markets have grown, are going up and up due to F2's inflow of money to a large extent. Mutual fund industry has grown in last 5 years, virtually has doubled. I think this pandemic will teach us and will make us learn how to keep our calm and ensure investors that they take best possible decisions. This pandemic will also teach us that investors should not chase only returns. They should take best possible informed decisions in the current circumstances. AMCs have played a very good role in creating education on investors that how to approach it and how to make our investments in a more diligent manner. That means to ensure that our risks are spread over and we take only risk which we can digest also. Any person to put all money in equity or all money in debt has to take in the light only what returns expectations, how much volatility they can digest, and what they can should take action when the times are bad. I am fully assured that this seminar will help investors also to understand how to take forward their future actions. Thank you.
Thank you, Mr. Arun. That was very enlightening. You are mentioning that investors should stay calm and take informed decisions. I think that is a lesson which investors should carry. Now I would take this webinar forward, and I would like to ask certain questions to the panel members. So, Mr. Mahalingam, sir, are you available? I think he's not there at the moment. So we will. Mr. Balasubramanian, how do you see the measures taken by policy makers in the last 3 months? How do you see the economy going forward from here?
Yeah, I think interesting, Mr. Guptaji, is I think the way, as I mentioned, that the way the policymakers have reacted globally, it's something unprecedented. And why I'm saying is unprecedented, the way I explained, the last time when not similar situation, but the financial crisis hit the world, they took almost about 3 to 4 months on a continuous interval to fix the issues. But this time around, they just took a matter of 1 week. They pumped in so much of money, which can be measured in as a size of the economy, which is close to about 10 to 12% of the economy is being carved out to support the pandemic-related impact that could have in the economy. That's something unprecedented. Even within India, the way Reserve Bank of India has come forward and pumped in liquidity, cut the interest rate so sharply. And today, there's so much of liquidity there in the banking system. The liquidity today is finding its way to Reserve Bank of India in the form of reverse repo parking of the money, surplus money, at about 3.75%. Therefore, there is a significant progress that has been made by the central banker as part of the reaction to these initiatives. Second, of course, the government of India, as part of the fiscal action, though government is quite clear about the fiscal slippages cannot happen, but at the same time, a fiscal slippage would happen, as Swati was mentioning in her presentation, that tax collection is not going to be the same as we've seen last year. At the same time, divestment through which they are supposed to manage the fiscal may find some kind of difficulty in carrying out the divestment. At the same time, the government also has to take some steps in providing the support through the budgetary provisions, which they've also done in the form of giving MSME a special window through the SEBI, through NABARD, through NHB, and as well as through the Reserve Bank of India, by giving us a first clause kind of limit. I think that's also, in my view, it's quite good. But one good thing that has happened, I think, from both the regulators' point of view, both the Government of India and the Reserve Bank of India, they have still not said that whatever they have done is the last one. They have still kept the card open, and then whenever we feel it is necessary to provide the support, incremental support, they will come and support. Lastly, of course, even Security Exchange Board of India, as a regulator, have also taken few steps in providing a legroom for companies during this period, either with respect to their reporting of numbers or postponing some of the results announcement. And there are some leeways also been given. Therefore, the way I see is the policymakers have actually come together, both in India as well as globally, to provide necessary support so that the economy, while it will suffer, absolutely no doubt, we cannot stop the economy suffering, we cannot stop the economy coming to the negative territory. At the same time, can the regulators help in creating a V-shaped recovery or a gradual recovery? This is only a debate that could have the next maybe the 1 year time frame. So I am quite happy the way they have done. Of course, we can always have an argument what they have done is not sufficient, because the market has always seen anything that you do is never seen as sufficient. I think as long as there is a confidence that regulators will keep looking at revisiting these decisions on an ongoing basis, provide the timely support, I think market would be happy to see such kind of movement.
See, the markets fell by about 38% during February and March, and now they are up by about 35%. So when the economy is doing so, we don't expect economy to do well. It is to be a contraction, but the markets are rising. So what do you think would be the reasons for this rise? I mean, is the fiscal stimulus being given in US and other countries also responsible partly for this rise? What do you say?
Yeah, I think it's purely liquidity driven. I think there are two things, of course, is there. From the market point of view, people look at what is the real interest rate, the real rate of return I'm going to get. You go to any asset class today, especially in US, the bond yields are close to about less than 1%. And even if I buy a gold, I think probably the gold can give me a real rate of interest more than 1%. So therefore, from an investor's point of view, the choice you have to choose between the asset class that is available, which is a bond on one side, on the other side you have real estate, and within real estate you have residential and commercial, and third, of course, the equity is an asset class. And the equity is an asset class at this point of time, while the earnings may not be supportive of the price movement, but definitely as a comparable asset class, as the way I think the unprecedented support that has been given by the Fed, it also increases the probability of a V-shaped recovery that one can expect. So one can argue that which side the recovery will come, one doesn't know, frankly. At the same time, one also cannot rule out the way I think support has come from the Fed government. One cannot rule out such a big push that could come as a surprise as well. Therefore, the money that is coming to the equity market after this sharp fall, after seeing the reaction that has come from the policymakers, there is some element of hope has come back. And having said that, this money also has to move into the other markets. The kind of money supply that has gone up quite substantially in the system is actually the historical number that we are saying it. Therefore, that number actually is finding its way to the equity market. The bounce back that has come in equity purely driven by liquidity, purely on the basis of hope that economic revival will come back soon. But actually, there are expectations that once the China lockdown gets lifted, we could probably see a spike in commodity prices, and because of some bit of investment activities could come back and the support of the respective government. These are some of the expectations that are getting built up in the equity market, and therefore what we have seen, probably I would say India is reacting a little slow, and given the fact that whatever we have done in India, all of us feel is not sufficient to revive the economic growth. I think the point what Swati mentioned about fiscal, I think in India, the challenge is actually whether we want to have a fiscal slippage and pump in the economy, or keep the fiscal as it is and don't spend money but wait for the private sector to spend money. I think we are in that dilemma. Whereas in the US, there's not a similar kind of dilemma. I think they have gone ahead completely to support the economic growth. Therefore, as long as the US market does well, you'll probably see the entire spectrum of equity across different markets to do well. It's purely on the basis of low interest rate, lower real rate of interest on traditional fixed income securities. Therefore, it finds its way to the other asset classes.
Yeah, but clearly these are very tumultuous times. And in these times, what should the investors be doing to minimize the risk to their portfolios?
I think having seen Mr. Gupta is from investors' point of view, I think it's a dilemma. Even from money manager's point of view, will always been a dilemma. I think what keeps the investors in good stead is the discipline what I mentioned about earlier. I think one first and foremost, asset allocation key to the success, which is nothing but going overboard and looking at equity as an only asset class. We may go through some kind of ups and downs what you have seen in the last 1 year. At the same time, if you change the return in the fixed income space, saying credit is one segment where I'll go and put all my money, and suddenly if there is a collapse of credit and downgrades happens, which you have seen in the last 1.5 years in India, that again create an apprehension in the minds of people is a credit fund is something which I should invest. Therefore, there is a wider feeling that fixed income and asset class also should not be looked at. But the way I look at, after having seen multiple cycles in the market, there are two things I think will make the investors to become successful over long term. Is one, a clear asset allocations, and second is a well spread between fixed income and equity as an asset allocations, and third, of course, a continuous way of investing irrespective of whatever the market conditions. I think when the market recovery comes, that is the easy time to get bullish on the market. And times like today is extremely difficult to get bullish on the market. I think best time to invest when there is a gloomy outlook in order to build a long-term portfolio.
I think what you are otherwise saying, buy low. These are times when markets are low, and this is a good time to buy.
Yeah, essentially keep building the portfolio.
In fundamentally sound scripts.
Yeah, exactly.
Yeah, but okay, while we are agreeable on that, but still there would be certain sectors which are at a risk, certain sectors which are immune. Would you like to dwell on like which sectors could be there which are immune to the current situation, the current crisis that we are facing, and which sectors or which companies would need to rethink their strategy in order to survive?
Yeah. You want to take the question, Swati?
Yeah. For you.
Yeah.
Should I take this? Yeah.
The Bala, that was for you. I mean,
Okay.
Yeah.
I got it. I think the way I see in terms of sectors, definitely the sectors which have got a secular growth. When I mean secular growth, the company which operates and segment the products and services are permanent in nature, such as consumer staples, consumer related segment, even a segment like infrastructure related sectors where the consumption will continue to remain in terms of demand for the product will continue to remain irrespective of the cycles. I think they would remain as sectors which are addressing the large pool of consumption theme across the globe will remain as a permanent theme, irrespective of whatever the market conditions. Pharma sectors will remain as sectors ever green, so to speak. The sector which will get, of course, impacted because of COVID, of course, subject to the business model undergoing a change. If you look at the airline industry, I think Buffett is the one who actually emptied his portfolio immediately after that COVID-related issue and came in thinking that airline industry will die. But in fact, after he sold, the stock price in airline industry would have been almost about 25-30%. That does not mean actually fundamentals are going to change. But the way I think consumers are going to spend, use the airline industry for the purpose of travels and other things, and there is going to be a significant change in the mindset of the users. Therefore, such an industry which will be subject to a lot of vagaries and they will probably underperform. There is also growing feeling that real estate sectors will get divided between the commercial real estate and residential real estate. I was listening to one of the leading promoter of a real estate company in Bombay, and he made an interesting point that some of the residential investors are coming back and asking, can you provide in existing premises another small room which can be converted an office space? Maybe about 100 square feet office within my own, say 900 square feet house. Such kind of model, it also could come up. Probably we'll also see the nuclear house model that was there, and people are moving away into different houses. There also could be another area. Maybe we'll probably see residential affordable housing picking up. At the same time, people start looking at business model and commercial real estate space. Given the fact that work from home is now becoming the new mantra, the new way of functioning, the new world, maybe we'll see some kind of suffering coming from that. Even the hospitality industries, especially if the travel gets reduced, therefore the staying in interest could be less. But having said that, I think the lockdown when it got lifted both in Hong Kong and US, there is a huge rush for visiting Disneyland in US. So what does it mean? It means that 2 months of lockdown also have made people actually go out and enjoy their lives. Therefore, it's too early to take a call. Tourism and industry will get impacted. It's easier said than done. At the end of the day, the consumer behaviors cannot be controlled beyond a point. Therefore, once the COVID-related situation comes back, gets settled, there is a high probability that industry which currently is supposed to be suffering may come back to some extent. So this is where I think the broad things are shaping as far as sector is concerned. But ultimately, from the market point of view, as a money manager's point of view, we'll have to start looking at the bottom-up way of looking at companies from investment point of view. And then that will remain as a focus area, irrespective of whatever the macro trend is going to suggest in terms of sectors that could do well and could not do well.
Yeah, thank you. I think Madam Swati also will have some thoughts on this. She is grappling with this situation, I think, on a daily basis. Yeah. What are your thoughts on this aspect as to sectors which would?
I would agree with Bala that it will have to be a bottom-up approach, and if I can just ask Harsh to take you to the slide number 18. Harsh, can you take it to slide number 18? Yeah. So key question now is to ask where is this pandemic is going to have a structural damage to the investment rationale that we would do, and like it is that there is a risk of the business model itself. The other question that we should be asking is that even in the industry or sector which is seem to be affected now, take for example travel and airlines. Bala did mention about this as an example. Are there any players who have a substantial competitive advantage versus others? And if there is a pain, First of all, whether they can sustain these challenging periods because they have balance sheet strength, and when the demand returns, would they be able to capture this demand because they are again in a much stronger liquidity position? So these are some of the questions that we should be asking. Also, if there are any valuation opportunities because of this, so I will talk about banks, for example, now. The same banks which were available at 2 times book, with the concerns on the moratorium and the SME pressure, the concerns on the asset quality, are there any banks which are adequately capitalized? Are there any banks which were available at 2 times? If they are available at 1 time, should we be just looking at the risk that is there, or take this as an opportunity? So that's the thought process I would have. And Harsh, if you could just go back to the slide on the sectors, I'll just one couple of more slides back. Yeah. So if you see in this sector, there are sectors where on a 3-year and 5-year also, there are sectors which have probably have their own challenges. And there are sectors which continue to do well because of the two important parameters which I was talking about, was the cash flow generation and free cash flow generation and the return on capital employed. So these are some of the important fundamental factors that we should be anchored to. Not so much about what is the noise level in the market. That is always going to be there. There have been cases when markets have fallen. For example, in 2007 to 2008, market fall was in excess of 50%. But the investors who stayed invested, they have gained much higher in 3-year and 5-year investment horizon. So I would make just that point to sort of support at the current disturbances. And Harsh, if you can just go to slide number 17. I'll just show you this slide 17. No, you were right. Sorry, 16 then. Yeah. So this slide essentially captures the importance of these two parameters. See, the internal universe at our place, we classify as R1, R2, and R3. Now, R1 are the companies which are companies which have more than 18% return on capital employed on last 5 years as an average. Now, we always invest for future. Now, this exercise was done FY14. We do every year and check what are those companies have retained those good qualities. 75% of the companies in 2019 retain those good qualities. So there is a fair amount of predictability that the companies tend to keep the good quality, and more importantly, the returns that they generated in 5 years was 99% simple return versus 57% of Nifty. So that's the thought process. There are companies in lower return on capital employed, but if you could pick them and there could be an improvement in the return ratios, such companies have generated 105% in 5 years. So that's the thought process, that investment process should be there to leave away the noise that the market puts from time to time and pick up the winners. That's the endeavor that we have. So that I would stop at that.
Yes. Thank you. I think Mr. Mahalingam is online, and I would like to seek his views. Mr. Mahalingam, sir, what have been the recent policy initiatives by SEBI, and also the steps taken by RBI and SEBI to ease liquidity issues of mutual funds due to the pandemic situation?
तुमच्याकडे डायल केला गेलेला नंबर त्यावेळी व्यस्त आहे. कृपया थोड्या वेळाने प्रयत्न करा.
So, do we have online?
So, wait a minute.
तुम्हाला डायल किया
Yeah.
गया नंबर
Yes.
कृपया कनेक्ट करा. तुमच्याद्वारे डायल केला गेलेला नंबर त्यावेळी
Do we?
कोविड-19 अनलॉकची प्रक्रिया
He's not going through.
Sir, please repeat the question. Repeat the question, sir.
Mr. Mahalingam, sir. Sir, what have been the recent policy initiatives by SEBI, and what are the steps RBI and SEBI have taken to ease the liquidity issues of mutual funds, especially due to the pandemic situation?
See, clearly, I think a good part of the initial problem actually started out of liquidity. So it was thought that RBI opening up a separate liquidity window on the lines of what they did in 2008-9 as well as in 2013 would be helpful. So SEBI did enter into a very furious kind of a dialogue with the RBI, and RBI finally consented to open a kind of a special liquidity window where RBI could give a repo for about 90 days at a fixed repo rate. And it could be availed by the banks by way of giving loans, or it could be by way of banks doing outright purchases, or repo against any collateral of investment grade corporate bonds, CPs, etc., etc. So in this case, the idea is that RBI does not deal directly with the mutual funds. It was using the intermediation of the banks to actually put the funds in. Now we saw that one thing was, although the window was open, not much was utilized in this window at all. Very small amount was utilized, but then that was sufficient to bring back some amount of confidence as far as the system is concerned. But a second problem that needed to be addressed very clearly was the liquidity which was faced, a tight liquidity situation which was being faced by the NBFCs and HFCs, and this had to be addressed by RBI giving a kind of a special window to that. So that also was addressed by RBI. That was again a very important window which could open up some amount of liquidity tap for the NBFCs. And the third important measure came from the government, by government actually opening up a backstop window which was actually willing to buy the corporate bonds, which is out of about 30,000 crores. Of course, this window is still being, as far as the implementation part is concerned, the modalities are getting worked out, and there is a constant correspondence, there is a constant dialogue which has been going on between SEBI as well as the government as to how effective this window could be, how effectively this window could be operationalized. This is something which is going to be very, very important, because while this is going to be a kind of a crisis-based window, I think there is a lot of thought process which is getting in to see that how the corporate bond markets could be liquefied, the secondary markets could be liquefied in a way that even the bonds which are below AAA, there could be some ready takers in the market. Now, this could emerge only by a window which could be opened with a substantial amount of capital from the government of India or from other stakeholders, which is willing to take in below AAA bonds, and this would infuse some amount of confidence as far as the market is concerned. This is still in works, this is still in process, and these things will certainly be worked out in the next few days. There are other things that the SEBI itself has done. One, it has increased the borrowing limit from 20% to 40%. It is being done on a case-to-case basis, on a mutual fund to mutual fund, scheme by scheme. But it has been quite helpful from the angle of relieving the concerned scheme, relieving the concerned mutual fund of any kind of a tight liquidity pressure which is coming in. There are other things that SEBI is constantly looking at. One is about the valuation of the overall the securities in the portfolio, and there are other things which are already there in the form of liquidity risk being actually provided for by way of keeping ready cash of liquid assets. Now, these are things which are being worked out on a constant basis. That's what I would like to say right now, Piyush.
Yeah. Thank you so much, sir. Thank you so much.
Thank you.
Madam Swati, see,
Yes.
today the economic slowdown, which is resulting out of the pandemic situation, as I was mentioning, has impacted everyone's portfolios. Now, in such situation, what should the investors be doing to de-risk or to minimize the risk to their portfolios? What kind of action they could take?
See, one thing is that the event has happened, right? So we cannot now go back in January and create, a higher allocation to maybe fixed deposits or some of the short-term liquid plans. So I think investors should always look at their long-term financial goals, and if at all, because of the equity allocation which has gone down now, we are talking about the valuations also corrected. So I would actually, as an equity investor myself and not as a fund manager, actually I would look to also, where I can invest in the market. Maybe I'll not invest in a lump sum, but I would look at that opportunity to correct the equity allocation that has gone down because of the price reduction. So, for example, my own allocation was about 80% to equity, because I have a job. So my allocation was 80% of my investments are in equity mutual funds. Now that has gone down to about 74%. Now I'll be looking out for an opportunity to invest. In fact, March I could invest only little. I could invest not at the bottom, but maybe first week of March, and I saw market falling down further. And now I'll wait for that opportunity. So that is one approach investors should look at. It's very easy to get convinced about the fall in the NAV, and therefore staying away from the market. But clearly, if I look back my own mistakes in the initial part of the career, and I have said that on many forums, that in 2003 to 2006, SIP was not the concept so much popular. And I initial years of my career, I was looking at markets opportunities. But if I just look back, and as I said, like if I would have invested even at 8,000 of Sensex, I would have been sitting on that portfolio 4 times at least gain, and I wouldn't have been bothered if 32,000 is becoming 29,000, because I have generated substantial portfolio allocation and wealth creation. So I think those who are on this webinar, who are young and who have, even if they are middle aged, or let's say even retirees for that matter, if you have that risk taking ability, you have sufficient amount to take care of your near term needs, there is no need to panic at this point of time. Imagine a person who would have panicked in March, thinking that, and March was the lowest number. It was just a few points away from the valuations that we had achieved or gone back in 2009 lows. Even today, price to book levels are close to 2.2 times, which are at the lowest level. In 2009, price to book for the market was at 2 times. So these are certainly not the times to kind of panic. Also, there are times when, when we talk about when the markets at all time high, there unfortunately the investors' confidence is very high, because they see large returns on their portfolios, and they tend to ignore valuations. Just to give you one example about the fund that we have, it is called multi-asset fund, where we have placed that fund on the very fundamental parameters. There is no intervention of the fund manager. Those parameters were suggesting about 40 to 45% allocation at the highs of market in Jan. And as the market corrected, that allocation has gone to 80% or so. And with the recent pickup in the markets, that allocation has gone down to about 78%. So that's one thing which is, without any human intervention, based on the parameters that the model has thrown. That is one thing which could be a guiding factor, but of course, individual risk levels, risk taking ability, and willingness are different. So I think the role of financial advisors is very important in this, because they have that last mile connect. They know what kind of risk investors are willing to take. I think Arun would substantiate this view.
Yes, exactly. I wanted to ask Arun only, because he's the connect between the fund and the investors. So, Mr. Arun, how would you advise your investor, or how are you advising your investors to handle this situation? How to lower the risk in their portfolio?
Yeah,
Can you share your thoughts on that?
Just what Mr. Swati has said me, these are the times where we need to hold our investor hand very tightly and very safely. Because when you see gloom everywhere, you read, you listen, you talk to your friends, you hear only one thing: very bad, very bad, very bad. Yeah, situation is very bad, but it's not end of the world. We think these are the bad times in which we should hold our hand, investors hand very closely, and try to make them understand that times will not be bad forever. The investors have seen very bad times also in the past, but the persons who have managed to invest their money safely in during those bad times have made a lot of money, not with tons and tons of money during those times. If you have the capacity to digest this volatility, keep that money in equity fund and you will make money. So we try to ensure that bad times, such times where we need to go closer to our investors, make them feel assured, and arrange what I said also, webinars, conference calls with the AMCs and our customers, our clients, to make them reassured again and again. Because bad times you need assurance virtually on daily basis or weekly or monthly basis. So they're not panicked. They see, market is going down, what will happen to our investment, we have lost money. We tell it's only notional loss of money. It's not actually you redeem the money and bring back the money in your bank account. If you stay invested and if you have capacity to digest volatility and invest some more money during these bad times, this money investment will increase your ROI substantially. We use this volatility or this pandemic to assure an investor that bad times are not forever, and if you remain calm, if you remain committed to your goal, and if asset allocation is very good, then stick to it and you will make good money.
Madam Swati, you are also a proponent of the thought on like growth at reasonable price and competitive franchise. Can you explain how these would work? And any examples on these line of thought?
Yeah, so basically when you apply growth at reasonable price, you are asking a question, given the underlying growth in a particular company, what is the price that you are willing to pay? So this approach therefore gives both the underlying growth analysis as well as valuation comfort. And also the competitive franchise, I think, my investment style has got guided by Porter's 5-point analysis, which talks about how to analyze a particular industry. Now, in the industry, there are certain companies which definitely have some advantages, and those advantages may be because of some durable advantages that they may have, maybe a strong brand or their deep investments into R&D, or they just have a massive distribution setup that they continue to lead for many years, and this lead gives them a very good financial position in terms of cash flow matching, and also in terms of the high focus on the profitability. So I'll just give you one example, and Harsh, if you could share the slide number 20. Meanwhile, he's sharing, I'll just talk about this company which is into a personal car manufacturing. This company has 3 times more the distribution setup versus the next competitor, and this company has generated above average industry growth because they could actually stay connected with what the customer needs, and 50% of their production or the volumes have come from the models which were launched in the last 2 years. So there has a continuous refurbishment of models, and if you look at the cash flow that this company has generated in last 5 years, was cumulative cash flow of 31,000. The next best company could generate only 4,500. So I think this is one, this gap of competitive franchise helps us in capturing that. Also, whenever there is a consolidation happening, this is very helpful. For example, I'll give you example of telecom. Now, the players were 8 to 9, and there was one player was very aggressive. Then that led to massive consolidation, the size of revenue and EBITDA shrinking. But that is also an opportunity for the players who could survive these, and that could be one of the thought process. These are some of the examples of how you look at competitive franchise and select stocks, because you are a long-term investor. When we ask our investors to stay long-term, our investment style also should be such that and I think in current times I do believe that these companies would sail through this challenging period, and also they will be able to gain market share whenever the recovery happens.
Yeah. And at this time, how do you perceive the valuation risk do you expect if the markets could go down further, and what do you
So
feel?
actually, if you look at valuation risk at this point of time, the what we should actually see is that the risk is on the other side. That there are certain stocks which are deep in the value, but we should ask the question whether what is the reason why they are in deep in the value. So, for example, PSU banks, I would give now without commenting any forward-looking view on these banks. Uh, if there are any asset quality related issues and if your capital is not adequate, perhaps these banks may fare poorly on the competition. When the growth returns, they will have to depend on capital infusion by government. So I would say that valuation risk at this point of time is just don't go for what is the cheapest, because cheap can get cheaper. But then also do not ignore the companies which probably are looking costly to you. Yes, there are some companies where you cannot explain the valuation, but look at whether these companies could survive over the next 30, 40 years, and what is that they have to survive. So maybe they would have a very good cash flow situation. Cash on the balance sheet itself could be upwards of 3, 4 times of the net worth, high net worth, good distribution. So these are some of the questions that you should ask to kind of mitigate the risk that you may have of ignoring certain stocks which are costly. And this again, I will just relate to my own career. In 2011-12, I have seen consumer sector getting massively re-rated. So before that, I had seen consumer stocks valuation only in the range of 10 to 15 times PE multiple. Today we are talking about those moving to 40, 50 times. Fortunately, I could change my stance and not into emotional connect, but at around 35, 40 times I could get into these stocks 5 years back. So you have to be open and check your belief versus what the company's actually numbers are.
Okay, thank you, Mr. Arun.
Yeah.
What is the view on the debt market, and do you see the debt funds reviving? What steps should be taken to see that the interest of investors in the debt fund revives or continues?
Thank you. Debt funds are in a very bit spot right now due to some past instances. Investors have to be very careful in selecting which debt funds they want to invest money in. If you don't do your own due diligence and don't understand the fund, please don't invest money in the debt funds, because people invest money in the debt funds on hope of getting a higher rate of return. But one should very, very clearly know that higher of a return means you are taking some extra risk also. So debt fund market has gone through some turbulent times right in the past, but I hope with SEBI and AMC taking good care, future will not be as bleak as it was in last few quarters. Going ahead, it is not a very easy road for debt funds, but mutual fund industry has taken a very good stance in this managing the debt funds, and they've been able to ride over these turbulent times. For investors, I would suggest them, before investing, see your horizon, see the asset quality, and ensure that what you are wishing for, only that is there in the debt fund. Do not get misled by expected ROI. Just ensure that the risk associated with the expected ROI should also be looked by you very carefully.
Yeah, good.
If Bala would add something to that.
Guptaji, if can I add to what Arun is saying?
Of course, sir.
While as I mentioned earlier, that fixed income one has to look at in 2-3 parts. I think that experience that people have got in the last 2.5 years are those schemes which invest in securities that are rated below AA and AA minus, and also the one time that we saw risk coming post this ILFS crisis. But otherwise, leave aside some of these incidences. I think fixed income as an asset class have been delivering very good experience to investors, except Arun was mentioning that if you expect fixed income to give you substantial higher return, high ROI, that you expect, therefore you chase the return in fixed income, then you will end up in a mess by way of investing in schemes that take higher credit risk. I think if you keep that out, and then keep this part of the allocation in the fixed income space along with the equity, there are schemes which essentially focus only on the high quality investment with the high liquidity in mind, high safety in mind, then comes the return, such as liquid fund, low duration funds, and short-term fund, banking and PSU funds, corporate bond fund. All such funds, 90-95% of the mutual fund portfolios are invested in these kind of securities. Of course, one has to also keep in mind the interest rate risk that could come, but predominantly, if one riding through the cycles, then fixed income can also give you a good experience. Only thing is, you should not, as Arun was saying, you should never think, I need to get double-digit return, therefore I go and look at investing in credit risk fund. That's something one should not. As long as you have the discipline, then it can work well. But also, one should not get away. One should not just completely ignore these assets just because there is an experience that one has faced in the last 4 months with the Franklin Templeton closing down some of the schemes for redemptions. And that something should not be generalized as an asset class is bad. So this is one of incidents, and I'm sure this will get resolved with the support of regulators and the way I think the trustees of the company will take action. But that's not make people generalize that fixed income asset class is bad, and it should be part of the asset allocation overall strategy, which I had highlighted earlier also.
Okay. Thank you. Yeah, Mr. Arun, we are currently, markets are said to be, we are in a crisis, and markets, some of the scripts at least, they are down. At this time, would you recommend that investors go in for a lump sum investment, or do they go for a SIP investment for their investment portfolios?
Again, it depends on asset allocation and your risk-taking capability. Always, what Mr. Mahalingam has said, the times are turbulent, and in this year, due to pandemic, growth will not be as per last year. Investors want to take return on the money, his expectations, it needs to be moderated, and then what return is expected, on that basis he should invest the money. In debt fund, what Bala has just said right now, except credit risk fund performance has been quite good across board. AMCs which have taken good care of their investment philosophy and they invest money in very good paper quality, in good asset class, a good return. After IFL, there have been few instances that credit quality has gone down. But in bad times of economy, we should be very careful about the credit quality risk. So investor has to bear in mind his asset allocation and bear in mind that what is his expectation to take care of that also. If asset allocation is very good and you are careful where you are putting money, I think he will make good money in both asset class, debt also and equity also.
No, something on the strategy. Now, a lot of investors are investing with some goals in mind, either a child's education or a child's marriage or building a house or something. Now, in case you are doing a goal-based investment, which is a long-term investment, should you kind of like as you near your investment goal, should you shift your investments to another safer havens?
I would always advise clients on that matter. If they have targeted for a goal and their goal is nearby, then one should not again charge that investment return, whether it will be same or it will be different during when he needs the money. As he nears the goal, let the investment be placed where whenever he wants the money to redeem, he get the money. Because he has fulfilled his goal. But investors are always looking for more and more. And this thought process of getting more and more many times result in getting them return getting late, delayed or less. This investment goal is very clear that when your goal is nearby, keep money only in AAA security asset class so that when they need the money, they will get the money.
Okay, that's a very very important aspect that investors should consider. I think our audience should take note of it. And now, how do you visualize the future of the distribution industry, or also the fund advisor industry, the investment advisor industry?
India has still very low penetration of mutual fund industry compared to other industries around the world. People need good advice. People need sound advice, and especially in the bad times, they need somebody who can hold their hands, who can guide them, not to react to the market noises, not to react to the things which everyone is saying. Just stick to their goals, which they have decided in the good times. When times are bad, and if you stick to asset allocation, you will make good money. In India, still, I think the scope is very big, very large. India still, people invest money on basis of some friend's advice, neighbor's advice, somebody's advice. And because they believe in that man, they invest money. But if they get good advice quality, I think people will more money, and need of good advice will always be there in the industry.
Thank you. Yeah, Bala, I come to a thought that which has been there on my mind, and perhaps a lot of investors' mind, is that the tagline of mutual funds has been that mutual funds sahi hai. And now some investors do start thinking that, well, is it really so? When they look at their portfolios, but only if they look at the portfolio for the last 3 months. But what would you say? I mean, how do you respond to it? What does the industry respond to it? I know you are also an industry representative and all the board of AMFI, which is the body for all the all the funds. So what's your view on that?
I think interesting question, Gupta ji. Interestingly, when I was a chairman of AMFI, at the time the whole investor education initiatives, I set the ball rolling by creating mutual fund Sahi as the other brand for the mutual fund. And I still remember the date on which we started under the presence of Mr. Mahalingam. And the way I see is that mutual fund Sahi, of course, it's right, because one, the industry has got all the credentials in place, whether it is form of disclosures, whether it is in the form of giving compounded higher return, or rather compounded return over the long period of time, whether it is in equity or in fixed income, or it provides an allocation strategy to meet their goals between, right from, I call mutual funds provides 4 different purposes it serves. One, it serves the purpose of savings, which is nothing but liquid fund. It serves the purpose of income, which is nothing but fixed income schemes. It serves the purpose of wealth creation, which is nothing but investing in equity. It serves the purpose of tax planning, taxations, which is nothing but investing in ELSS schemes. So actually the 4 buckets are there under which mutual funds are providing product. And second is with respect to the disclosures. 100% disclosures, no other industry, whether it is insurance industries, banking industries, nowhere such disclosures are determined. Even in the global market, 100% of the portfolio is never disclosed. And third, with respect to the way the regulatory framework ensures that the mutual funds manage the money with a lot of fiduciary responsibility, that also comes. Because return is one part, sometimes it may make you think, is a mutual fund sahi hai? I think if somebody has the same questions were asked in 2008 after the Lehman Brothers crisis, the market did not go anywhere for almost for a 3-year period. Zero return on lump sum investment. Even the best of the people, highly intellectually capable people, started questioning, should I continue my investment? And believe me, one good market that came in 2014, 2015, completely reversed the game. And the same thing we have seen post Ashish Mehta's scam in 1992, post I think the recession that we saw in 2002 or 3 in the auto sector, we saw it. I think after multiple such kind of falls, the market, as long as you stick to the gun for longer term investing, it serves the purpose. Therefore, the mutual fund Sahi is definitely good. It stays relevant and stays apt as long as you keep your investment, one, the long term. Second, keep it as an asset allocation tool for managing your the goal that you have individually and the purpose for which you are investing. I think short term, yes, it may make you think that whether I have taken the right decision or not. But that is not the way to look at mutual fund as a vehicle. While investing by any of the players, whether it is you and me as individual investors or HNI investors or even retail investors, have to have this mind that yes, I'm investing for long term. Therefore, short-term volatility in the near term have to be ignored as long as keep up my goal and purpose for which I'm coming as constant.
So now I'm taking some of the questions which we are receiving from the participants who are with us. Now, one of the questions we have is that when the market was at 10,000 level Nifty, or at 12,400 level, or at 8,000 level, almost all AMCs have been saying that at this level, market is reasonable, not costly, and stay invested and add more. Now, what is the rationale for that? I mean, at all levels, they have a doubt on this thing.
So, Swati, you want to take this question?
Yeah. The question whether the Nifty was at 12,400 or 10,000 or 8,000, which is all over the last 1 year itself, then AMCs have been saying that the level is reasonable, but people have been losing money.
I think I can give you example of companies promoters and the short-term investors. The promoters looks at the company as a going concern for many years, and therefore there is a value. Similarly, fund managers or the manufacturers of equity products are looking at equity as an asset class which is going to be there for many years, and they want investors to have a adequate allocation. Now, as a cohort like Indian investors, if you look at, our most investments are in fixed income side or the fixed deposits. On an average, the allocation to even if you look at the numbers that BSE 30 and BSE 500 ownership numbers are concerned, today the fact is mutual funds with retail participation and the insurance companies put together are owning only about 12 to 15% of the companies reflected in Sensex and 500, BSE 500, whereas FIIs are owning more than 20 to 25% is their ownership. So there is a big disconnect. We are not confident of participating in India growth story of our own companies. So that's one thing, first thing. And at times, all our interactions, we do discuss where the valuations are, and we tell them that these valuations are at the either at the fair value zone or higher than the fair value. And from here on, we don't think that re-rating might happen, but earnings growth has to catch up. Now, unfortunately, in last 1 year, even before the COVID happened, the economic growth that India was going through wasn't that great. You take cyclical sectors like automobile, for example. We had NBFCs getting into asset liability mismatch problem, and they reduced their growth. That affected financing to the automobile sector, real estate sector. Then we had the regulations changing from compulsory insurance for 3 and 5 years. And third thing happened was moving from BS4 directly to BS6. So all this meant that your cost of borrowing was higher, you had cost of ownership going high, and all that had an impact on a sector like automobile. So I think when the economy is not doing well, there are such periods when the markets might have a disconnect between what economy is and where the market levels are. That can very much happen in short term, because market is made of many investors who are perhaps not looking. COVID is the risk is known. What we don't know is how long it will take the economy for recovering. But if my horizon of investment is longer, it actually doesn't matter. In fact, I'm again telling that could be an opportunity to build up your investments, introspect how much you are holding as an allocation to equity asset class. And I also believe that in these uncertain times, actually trying hand at direct investments, I think one should actually critically analyze that also. It's better to depend on certain mutual funds which would have a much methodical approach towards managing these risks. And also we have to balance between getting the upside potential also.
Yeah.
Gautamji, can you take one or two last questions since already 1:40?
Yeah. Mr. Bala, there is one question we have from a distributor where they are asking that at the time of investing, we did the diligence about what is the fund quality, what is the scheme, and whether it is investable grade or not. And thereafter, after investment, the constitution of the investment changes. Then, should one monitor the funds every day or every month, and whether the full details are openly published of the investments and all?
Yeah.
What's
Of
your
course, I would say that I think I think the mutual funds gives lots of information, both by the fund houses as well as available in the public domain. Sometimes I do wonder, whenever we see some fluctuation in the equity market, within a few seconds or few minutes, WhatsApp will be circulated that who owns what in what percentage, what is the impact on the portfolio. I think we are now gone to a certain extent that disclosure is no more is in short supply. Disclosure actually is sufficiently disclosed. The question is how one interprets such information in a constructive manner, in keeping the faith on the money managers, faith on the fund house, faith on the investment under which he has also made an investment. He's also advised his customers. I think all of them have to actually taken together into account while forming an opinion and judgment. And disclosure is not an issue. It's about interpreting the impact that one could see. I think if you analyze and start interpreting, you can probably come to a conclusion that things are very bad. But if I give a little long rope and then start saying actually that if I give more time, would it have any real impact or would not have that kind of impact that we are assuming? I think probably we'll get an answer to that. And to the extent I would assume mutual funds have been pretty decent in terms of disclosures. But I come back to my earlier point that I think mutual fund industry is one industry. It's a quick learner. Though one may argue that it comes at the cost of investors or it may come at the cost of something else. But they're quick learner. They fix the issues. And that's why I've seen it evolving in the last 25 years. And therefore, that anything that we see in today's portfolio, maybe going forward, you'll probably see much better input and disclosure that comes probably what you would have seen, say, about 1.5 years back.
Yeah. We have another question this time from a professor and addressed to Madam Swati. Madam, when we are investing, when the investors are investing money, they have perhaps 30-40 years horizon in mind as their investing horizon. But the companies they are investing in, whether those companies also look into the externalities, the risks that they have, and on a longer term, and how do the companies also perceive the risk and how do they cope with that?
Yeah, I think it's a great question because there are market risk, which we call that might affect all the companies same, but there are company specific risks also. And even when you maintain a portfolio, let's say even when about competitive franchise, if I'm maintaining a portfolio of 45 to 50 stocks, because it's a diversified exposure, even if we come across certain companies where the advantages are not sustainable, they are not durable, we can take action by exiting those companies. And I can give you examples here. For example, again, I'm giving examples from a banking side. I used to own good companies which had very good current account and savings account balance, which is, that gives a low cost of funds. But capital adequacy started to become a problem. Asset quality problems came up, and therefore the advantage that was there on the liability side was quickly getting lost on the asset side of the bank. So the point which I want to make is that when you maintain a portfolio of companies, there could be possibilities that certain company specific risk could be higher, and you need to take action. So companies may make mistakes. For example, some companies might have poor capital allocation decisions. So we should be vigilant about whether the incremental capital is going into the areas of core strength, or there is non-core investments which are happening, which might dilute the returns that these companies have. Or are they giving too much of working capital just to having very aggressive practices in terms of giving more credit? Or some companies might just give have very high optimistic assumptions about, like for example in infrastructure space in 2007 when road projects were built, the assumptions for traffic growth were very high. The economy doesn't stay what optimism you are saying. You should always question that, as you question pessimism now in the current times. So I think that is what we need to do: continuously review and keep trimming the portfolios.
Thank you so much. I think that is all we can accommodate today. And thank you to all the panelists and Mr. Mahalingam sir, Mr. Balasubramanian, Madam Swati Kulkarni, Mr. Ladha, the audience. I would like to thank all of you to have been present here and being involved in this very involving discussion, very engaging discussion. And I take this opportunity to also thank thank to Mr. Mahalingam, the full-time member SEBI, Mr. Balasubramanian, and Madam Swati Kulkarni for the great presence and rich insights. I would also like to thank Shri Anup Khandelwal, President of ANMI, who has also supported this conference. I think the session has captured the current sentiments very succinctly, and addressed the issues which are present or which are being faced by investors, and have also given perhaps a way forward on how to look at investment. The life doesn't is not contained in a 3-month period or a 4-month period. Life is a much longer period, and it is definitely something that you would want to look at on longer term. But it is necessary that people keep their cool, keep their fundamental understanding, and invest by managing the risk and into the correct sectors. And with that, I would like to thank all of you. Thank you for your time. Thank you for your contribution. Thank you so much, sir.
Thank you. Thank you. Thank you.
Thanks.
Thank you.
Yeah.
Can we